Alright traders, so in this video I want to discuss about three chart patterns that you can successfully trade in bear markets. So today, CRISIL came out with a coverage that India is going into the fourth recession. This was covered by Goldman Sachs a couple of days back. Talking about Nifty banks at all-time low. We're trying to test the 17,000 support. That's a very crucial level. And Nifty is also hovering around the 9,000 range and probably going to the downside. The global markets are recovering because it seems that coronavirus has peaked in the European zone and the American zone, but not so much in India. So in such a market, what do you do? So if I talk about myself, I filter my stocks and I only short. I don't really go for a long position when I've registered that markets are down, when the stocks are down. So these are three chart patterns that I love to trade when the markets are bearish. So the first one is pullback to support. That's one of the easiest one that you can trade. So for example, in the charts of Nifty, the 5 minute charts, we can form a really strong support level in this area. So you just have to draw your support. Prices, bounced back up, took a support at this level, bounced back up again, was unable to go reach higher highs, and at this point it breached the support. So whenever prices, breach the support, when the support is broken, essentially the support turns into resistance, and that is what we are looking for. We are looking for a pullback after the support is broken. We wait for a pullback, prices pull back, test the support earlier as the resistance, and we want to initiate our short positions at this point. So that's one of the really very strong and important patterns that you look for in a bearish market. So the support, when it's broken, wait for the pullback, and you can initiate your short positions at the pullback. Another example, let's see the charts of Nifty Bank. So this is the charts of 25th. So this was a very one sec. So this was a very important support for Nifty Bank, right? So there was multiple testings at this price. Nifty Bank was unable to cross the 17,500 zone, and after a lot of pressure in the second half of trading session, it breached this the support with a heavy volume. So that's a breakout, a breakdown essentially. And what we're looking at is the support turning into resistance. We wait for that pullback, and around this point, when there's a pullback to support, we sell and we get that profit. So this is one of the easiest patterns that you can look for in a bear market. So support turns to resistance, wait for the pullback, and short when you come and test that resistance. So let's talk about the second pattern that I love to trade in bear markets. That's the outside bar, or as you call it, the bearish engulfing. So bearish engulfing is one of the strongest bearish patterns that is there in the market. What is happening in a bearish engulfing? So this is the bearish engulfing. So what happens is that there is a slight or a big uptrend in the market. For example, in this case, we had a big gap up on the charts of HDFC 5 minute charts. So when the prices gap up, the highest candle will be green in color, and this will be followed by a red candle, a bearish candle, and this bearish candle will be fully engulfing the earlier green candle. So if you don't know what the bearish engulfing is, I have done a video earlier, so make sure you check that out. And so when the bearish engulfing happens, this basically means that the uptrend, which was very strong, there's a selling pressure that is emerging, and prices will start to fall. So two things that I like to make sure when I'm trading a bearish engulfing is that I need a good volume. So make sure the volume on the bearish engulfing day is much higher than the 20-day average. So you should always have a 20 moving average on volume. A lot of people don't know how do you get that. So you can just go on the settings and click on show moving average, and put the length of 20. So you want a 20 period average on moving on the volume. So you should have a high volume on your bearish engulfing day, and the next candle following the bearish engulfing should open lower. So when it opens lower, you can go short, take a short position, and enjoy the profits. So that's another very wonderful example that I love to trade in the bear markets. The third example is the third chart pattern I like to trade is called the double top. So this is the charts of Tata Consultancy on the 5 minute time frame. So we can see that this is a very good support, in the time frame. What is a double top is basically what is happening is prices try to go up higher. They fail. They fall down to a level of support. Again, they bounce back to the same level and they are unable to breach this level of resistance that was formed earlier. So basically what happens, it is giving you a M kind of formation. So if you have a look at it, it's a M kind of formation. Prices go up and this is a bearish engulfing. That's a good chart pattern that you can trade. Prices fall down to the support, to the neckline. Prices again go back up. Again, they test that same level of resistance and they fall down, just to find out that this time they are not going to take support at this zone, but they will be breaching this support area. So it's a breakdown. So what do you want to do in this case is the price, from the level basically from your support to the head, the top, it becomes the target. So you can, the price that it has gone up, that becomes your target, and you can keep that as a target for your short. Stop loss can be kept just above this support. That's a very good chart pattern that you can trade. This was involving two bearish engulfings, as you can see. So it was a very strong chart pattern. Another example of the double top would be on the Larsen and Toubro. This is also just recently on the 5 minute charts. So as you can see, prices make an M kind of formation on the 5 minute chart. They took a good support around the 835 zone on the first time, on the second time, but when they came on the third time, it was unable to test it as support and it actually broke down. This was followed by an increase in volume, so this shows that the breakout is effective. So you can short at this position. What will be your target? Target will be the price, the distance from the support to the head. That will be the target that you will be going for, and your stop can be maintained at just above the support. Talking about the stop loss for your bearish engulfing, if you trade the bearish engulfing, you can keep a stop above the opening of the bearish engulfing. So that's something that I like to do. And if you go for the pullback to support, the stop, if you're shorting at this point when you test the resistance, you can keep a stop loss just above the support. Don't keep it at the support because it might be tested, so you want to have a little gap so that your stop is not affected. So that's all for now. Let me know how, whether you trade these patterns, and how you trade these patterns. Are there any variations, or if there are any other patterns that you like to trade in the beer markets, do mention in the comments, and I'll see you next time. Thank you.